Imagine a family bank that never runs out of money, a system where every generation can borrow from it for life, and the loan gets erased when they die. This is the Rockefeller waterfall method. Here's how it works. First, you create the family vault. That vault is a trust. The trust owns everything important: life insurance policies, cash value, life insurance, investments, and other assets. The trust, not any one person, becomes the core of the system. Next, every key family member is insured. Parents, children, and even grandchildren. Each policy is built for strong cash value and a solid death benefit. Then comes the crucial detail most people miss. The trust is the beneficiary of every policy, well, not individual heirs. So when someone passes away, the money flows straight into the family vault, not into a personal account to be randomly spent. Inside that vault, cash value life insurance becomes a family bank. The cash value grows. The trust can borrow against it to fund businesses, real estate, education, and big opportunities. But here's the twist. Family members don't get handouts. They get loans. The trust sets the rules. How much, for what purpose and hours, and how it's repaid. And that's about, that keeps structure, discipline, and control. Then the waterfall effect kicks in. When a family member with a policy dies, the insurance company pays a tax-free death benefit to the trust. That money refills the refill vault, often replacing or exceeding what they borrowed in life. Each generation adds more policies. Every birth, every death sends more money flowing into the trust decade after decade. The trust invests like an institution, buying real estate, building businesses, purchasing more policies, and funding long-term projects. Over time, it functions as a privately owned family bank. This works because money is never scattered. Assets stay inside the trust, and each death becomes a deposit, not a disaster. Instead of shrinking, the family wealth grows with every generation. Most families never build this structure. They skip the trust. They buy small term policies, and leave cash directly to heirs, who often just spend it. The wealthy do the opposite. They build the structure first, then route everything through it. You don't need Rockefeller money to start, but you do need three things: a properly set up living trust, the right beneficiaries, and a clear plan for how life insurance and assets flow into it. Without the trust, there is no waterfall, just scattered money and another opportunity lost for the next generation.